Focus brought to you by IG, taking a look at recent Chinese data, how bad it's been, its effect on the US dollar, Chinese stocks, US stocks, the whole global economy here, as China has not been able to pick up its economic data over the course of the last couple of months. And it's really, if you haven't tuned into either the story of Chinese data, economic data in general over the course of the last half year or so, or Chinese stocks, Chinese interest rates, currencies, it's telling a very different story. It's been a very different story than that of the U.S. And we're going to highlight that story, but then also do some comparing as well, as worse than expected trade balance brought U.S. dollar higher. Now, of course, I know Japanese yen isn't a Chinese currency here, but it's just a more liquid measure of how U.S. dollar has been performing. As last week, the U.S. dollar took a hit on the expectation that maybe U.S. interest rates had topped out. U.S. employment data that came in was a little softer than expected. And a lot of people wrote off this U.S. dollar of, oh, okay, it's going to start its descent now. And if you've been measuring the U.S. dollar versus the euro or the pound or Aussie, which we'll get to in a second, or the yen here, you can see that it's bounced right back. And this dollar versus the yen right back above 150. And right back at those historical highs, as there's growing fear of a global economic recession from the Chinese data that has come out. A lot of people flocking to dollars. And of course, Japan being close geographically to China can bear the brunt of some of these global fears, as well as the Australian dollar, close trade partner to China. And if their economy is hurting, Australian economy is often hurting as well. But we'll get to that in a second. Let's get into the data here, as trade balance is a measure of exports minus imports to essentially say, okay, net, how well is your economy doing? And this number can be more and less relevant depending on your economy. China, for example, is a huge exporter of goods, and their economy is very dependent on those exports. Whereas, the U.S. trade balance is very important, but maybe not as important as it is in China. And here, dissecting the export piece first, this is the 6th month in a row where year-over-year export growth is negative, and the expectation from trading economics forecasts was around negative 3%, and it came in worse than negative 6%. So almost twice as bad as expected. And hasn't produced positive year-over-year growth since April of this year. And even before March and April, you see more, declines year-over-year in exports for an economy in China very dependent on exports. And then also the cherry on top of this sour sundae here for China is the fact that imports actually surprised and were up year over year, 3% increase to goods coming into China. And as you can see here, in the last year of activity, only the 2nd month to produce a positive import growth rate year over year, first time since February. And so surprises on both ends here, worse than expected exports, more than expected imports, not even a negative number, or not even an as bad negative number as expected, but a positive number here to imports. And this brought the total trade balance down to its lowest level since February, where there were some, chunky economic data points in there. And if you take that Feb out, this is the first time that trade balance in China has traded in the 50 handle for the last year plus. And so, really important economic data point here in trade balance, and it's been contracting pretty consistently over the course of the last several months, and now reporting its worst month since February. And this saw a bunch of different reactions, as you might expect. Some fear in Chinese stocks, fear over the Chinese economy in general, some flight to quality in U.S. treasuries and some other markets, but also Australian dollar being sent lower just when you thought it was safe, and that Aussie bounced back to around 65 cents, now trading today at its lows. It was off almost 100 pips, and it lost between 60 and 70 pips when all was said and done, and trading back close to 64 again. And the low here for Aussie in 2023 has been 62, 63, and going back to last year, that low has been right around 62. So pretty close to those lows. And if economic fear continues to build in China, its adverse effect on Aussie and Japanese yen, and the bullish effect it's had on US dollar could continue a little bit, as that dollar has risen with global economic fear. Now, if some of that dissipates, you see Chinese stocks fight back. Some economic data points from China that point to some economic bounce back, then you could see this Aussie bounce back and that dollar give away some ground. As you look at the long term for Aussie versus USD, and much more time has been spent in the 70 to 80 cent handle, whereas in recent years, a lot of trading in the mid 60s. And you can see here, I laid on top of this Australian dollar to US dollar chart the Chinese large cap stock ETF FXI. And you can see that they're very closely tied. The correlation is obviously there, as these two markets, Aussie and Chinese stocks, put in their lows for the last year or so of trading in October of 2022, bounced back through the end of the year and the start of 23. But since then, it's just been a grind lower for Chinese economic data, Chinese stocks, and Australian dollar, as it's been the inverse for this US dollar. There's been some bumps in the road for USD versus Aussie versus yen versus euro versus pound, and throw Canadian dollar in there as well, and major currency pairs. But it's been a grind higher here to a large extent in 2023, when at the start of the year, it looked like dollar was ripe to give back some of its ground that was gained in 22. Dollars have really been a flight to quality amid this global recession potential heightening over the last couple of months, especially. And you might expect that trend to continue if fear continues to build in China and the neighboring economies there. The US dollar maybe gets to a new high against a bunch of these currencies. But again, if that fear does dissipate even a little bit, maybe there's more elasticity to US dollar's downside, just given that it's at such historic extremes. And I also wanted to rope in a little bit of the stock piece here, just to show the relative performance. We talk so much about interest rates and how that affects forex and everything else, but worth noting that Chinese stocks are underperforming US stocks here year to date by 50%, as the NASDAQ is up 40% on the year, and Chinese large caps in that FXI ETF, by that measure, are down 10% on the year. Pretty wild action, because of course there's a positive historical correlation between stocks here in the US, stocks in China, stocks in Europe, stocks everywhere, right? We live in this global economy here in 2023, and it's been that way for really the mid 2010s. You've seen a high correlation between these different global stock markets. And obviously a lot of the Chinese large caps are tech companies. Alibaba for a minute there was considered a global competitor to Amazon, and eBay and a lot of these other US stocks that have performed so well over the course of the last several years. And you're getting this not only underperformance, but moving in a different direction here as Chinese large caps, down 10% in the same time that NASDAQ and US large caps are up 40%. So we'll see if that gap can close. We'll see if some of the fear comes out of this Chinese economy. It would definitely start with some of these data points turning around, getting an uptick in that trade balance, an uptick in exports, because you can see it's been a very different story over the course of the last 5 years. Here you have the equivalent of the U.S. overnight interest rate. China's interest rates have been falling for the last 5 years as an incentive for economic growth, right? Interest rates, central banks will lower interest rates to try to spur on economic growth in times when they need it. And over the course of the last 2 years, especially since the pandemic of 2020, U.S. rates have been moving to new highs for the last decade. And in the same time, China cut around the pandemic and then cut even further since then. So right now, getting a very different story between China and the U.S., wondering if that gap can further expand or contracts at some point. If it does contract, that's either U.S. stocks falling to meet Chinese stocks performance or Chinese stocks finally bouncing back. But it'll be specifically interesting for the forex market because, you might think your first intuition might be, oh, well, if the U.S. sees some economic crisis of its own and has to lower its interest rates, and that U.S. dollar might fall. But keep in mind that this is a game of relativity, right? You could see this global recession kick in, and if it's worse for Asia and Europe, then dollar could be an even further flight to quality, even if the U.S. does start to see some of that fear from abroad seep in, and they have to maybe lower interest rates at some point, like China's already been doing, like Japan, never hiked interest rates over the course of the last 5 years. And so it'll be a really interesting story, not only for, Chinese data relative to the US, Chinese stocks relative to US stocks, but this currency piece is even more nuanced here. And it'll be really interesting to see if there's a bounce back in Chinese data. You'd almost expect that to be the path forward for US dollar moving lower, as opposed to even if the Chinese story gets worse and it seeps into the US, it might be a reason for US dollar strength. So many options on the table, but all we know is that Chinese data has not been getting better, and it's brought US dollar right back to its highs.